In early 2026, gold reached $5,600 an ounce. 5 months later, it fell below $4,000. It was a 30% collapse that wiped out massive retail portfolios almost overnight. Financial media focused on a predictable set of headlines. Analysts pointed to a strengthening US dollar, high interest rates, and natural trend exhaustion to explain this sudden, violent drop. This chart tracks the global spot price against sovereign physical accumulation between January and July 2026. While the spot price, the red line, crashed, the solid gold area shows physical reserves quietly surging. The People's Bank of China continued a 20-month buying streak even as retail prices plummeted, importing a massive 692 tons of physical gold during the first 5 months of the year. The data suggests a deliberate, mathematically engineered market clearing designed to phase out volatile retail leverage. This correction creates the architectural floor required for the next multi-year institutional supercycle. It removes the instability of paper speculation to prepare for a physical-driven market. This clearing phase reached a critical deadline on July 24, 2026. On that day, China's largest financial institutions, led by ICBC, permanently ceased all retail precious metals trading. Every bank involved issued a similar statement. They were protecting everyday investors from extreme market volatility and the risk of total portfolio destruction. Historically, retail investors in this market have utilized massive leverage on paper contracts. During the 30% price drop, these positions amplified the crash as cascading margin calls forced more gold onto the market. These leveraged paper positions create an engine for severe short-term downward volatility. During any market dip, the mechanical nature of margin calls forces prices lower than the physical supply-demand balance would suggest. By ending retail access to these products, Beijing effectively removes the mechanism of paper leverage. This ensures that short-term retail panic can no longer destabilize their long-term physical accumulation strategy. In standard commodity trading, leverage allows a participant to control a large position with only 10 to 30. Removing these paper traders neutralizes the primary downward amplifier in the gold market. Without the constant threat of margin-driven sell-offs, the price floor for institutional buyers is significantly higher. Forced selling in the Chinese retail market has a direct physical manifestation on global technical charts. It creates a predictable structural pattern of price exhaustion. Gold's price is squeezing into a descending wedge. Past cycles show drawdowns becoming shallower. 1980 saw a 66% drop. 2011 tightened to 46%. This trajectory suggests the current bottom sits near 37%, projecting a cycle floor between $3,500 and $4,000. The technical false bottom on global charts aligns directly with the July 24th retail liquidation deadline. Both indicators signal a coordinated market clearing, the final shakeout before the supply-demand balance resets. Once the July deadline passes, the technical overhang of retail liquidation is resolved. The constant downward pressure from paper margin calls disappears permanently. The market resets to physical reality. Central banks continued accumulating physical gold at record levels, completely unaffected by leverage or short-term paper volatility. However, transitioning from a technical bottom to a full bull market requires a specific catalyst: sustained weakness and growing doubt in traditional equity markets. Capital does not vanish during periods of stock market uncertainty. It relocates. Institutional wealth moves quietly into hard assets long before it becomes mainstream news. The absence of a total stock market panic today suggests the gold opportunity is still in its early, quiet phase. The most significant move only begins when traditional confidence starts to break. JP Morgan projects a $6,000 target this year. From here, Path A offers a gradual recovery, while Path B involves a final violent dip before a rapid repricing. Both converge toward a 2033 cycle peak, targeting $13,000 per ounce. Strategic positioning requires looking past the immediate volatility. It means preparing for the eventual recovery while being ready for a final, sharp washout in the paper markets. The current market weakness provides the engineered architectural foundation for what the data suggests will be the most significant wealth transfer of the next decade.